In the first week of January 2026, COMEX warehouses recorded the withdrawal of 33.45 million ounces of physical silver in just 7 trading days. That is not a typo. In 1 week, more than a quarter of all registered silver, the only silver legally available for delivery against futures contracts, vanished from the exchange's approved vaults. The paper price of silver at the time was trading around $72 per ounce. Physical buyers in Dubai and Tokyo were paying over $130. That gap, 80% between what the futures market said silver was worth and what a buyer actually had to pay to hold real metal in their hand, had never been recorded in modern precious metals markets. By the end of this video, you will understand 3 things you almost certainly do not understand right now. You will understand exactly what COMEX registered inventory is, why the number that matters most is almost never the one quoted on financial television, and why the gap between that number and the outstanding paper claims against it is now at levels that historically precede extreme dislocations. You will understand why Shanghai is pricing silver differently from London and New York, what that divergence reveals about where actual physical demand is coming from, and why the arbitrage mechanism that should equalize those prices is no longer functioning normally. And you will understand a buried detail from the COMEX delivery reports of January and February 2026, a detail that major financial media has not connected to the broader story, that tells you something fundamental has changed in how the largest institutions on Earth are positioning themselves in this market. If you want to understand where silver actually stands right now, stay with this. To understand what is happening, you need to understand the structure of the COMEX silver market. COMEX, the commodity exchange, is a division of CME Group, the world's largest derivatives marketplace. The standard silver futures contract on COMEX represents 5,000 troy ounces of silver. These contracts are bought and sold continuously, and on any given day, the total number of outstanding contracts, the open interest, represents an enormous notional quantity of silver. The critical point is that most of these contracts never result in anyone taking delivery of actual metal. They are used for hedging and speculation, and the overwhelming majority are cash settled or rolled forward before expiry. The silver that sits in COMEX-approved vaults is divided into 2 categories. Eligible silver meets the exchange's purity and bar weight standards, but is privately owned, and its owner has not made it available for delivery. Registered silver, by contrast, carries a delivery warrant. It is the only silver that can actually be handed over when a futures contract buyer demands physical metal. That distinction is the entire story right now. According to data from the CME Group warehouse stock reports, registered silver inventory in COMEX-approved depositories stood at approximately 86 million ounces as of late February 2026. That number represents a decline of 64.1% from the April 2020 level of 240 million ounces. Meanwhile, open interest in the March 2026 silver contract alone represented around 528 million ounces of exposure, more than 4 times the total registered stock in the entire exchange. The coverage ratio, the percentage of paper claims that could theoretically be satisfied with registered metal, stood at 13.6%, as tracked by public inventory monitoring tools sourcing directly from CME data. Below 15% is formally classified as stress territory, historically rare and associated with delivery pressure events. Paper leverage sits at 7.4 times registered inventory. At the withdrawal pace recorded in late February, analysts estimating from the same CME data suggest registered stocks could theoretically be exhausted within approximately 70 trading days if no new metal is deposited. Now, the most important counter-argument to everything you have just heard is this. These ratios have been elevated before, and the market has never actually defaulted. Almost nobody who holds a COMEX futures contract actually wants physical silver. The system works precisely because delivery rates are historically low, typically 2 to 5% of open interest in any given month. If 95% of paper holders always roll or cash settle, then the leverage ratios become less alarming. That is, the steel-manned case for the bears on this thesis. It is a legitimate point, and the data supports it historically. Here is where the current picture diverges from that historical baseline. According to CME Group's monthly delivery reports, February 2026 delivered 5,036 contracts, equivalent to 25.18 million ounces, making it the highest February delivery volume in modern COMEX history. January 2026 delivered 49.4 million ounces, 4 times the January 2025 figure. Total COMEX silver deliveries in 2025 reached 474.4 million ounces, more than double the 2024 figure of approximately 203 million. The delivery rate as a percentage of open interest ran 12 to 22 percentage points above historical norms across those months. The assumption that almost nobody demands physical delivery is no longer holding. What the LBMA spot price and the COMEX futures curve show is one picture of silver. What the Shanghai Gold Exchange and Shanghai Futures Exchange show is another. The Shanghai Gold Exchange runs a deferred settlement contract known as AG-T+D, a highly liquid physically settled instrument that serves as China's primary real-time silver price reference. The SHFE silver futures contract has been physically delivered since its debut in May 2012, with each contract representing 15 kilograms of metal. When you convert Shanghai prices into US dollars at current exchange rates, the benchmark price on the Shanghai Gold Exchange has in recent weeks tracked between $85 and $90 per ounce, broadly aligned with LBMA spot prices, and at certain points trading above them. This is not the exotic gap it was in December 2025, when Shanghai premiums exceeded $8 per ounce above COMEX prices, but the underlying dynamic has not resolved. Shanghai inventories on the SHFE fell from approximately 559 tons in November 2025 to 318.5 tons by late February 2026, a decline of 43% in roughly 3 months. The Shanghai Gold Exchange recorded its lowest registered inventory since 2015 during the same period. Physical demand in China is not theoretical. Metal is leaving vaults in both New York and Shanghai simultaneously. Here is what nobody is putting together clearly. The COMEX delivery reports from January 7, 2026, published by CME Group, show JP Morgan as the issuer on 99% of 8.1 million ounces in delivery notices, representing 1,624 contracts in a single reporting period. What made this unusual was not simply the volume. It was that open interest in that contract month simultaneously increased by 1,431 contracts, despite those deliveries being processed. Under normal market conditions, delivery reduces open interest as contracts are settled. New buying against the open position during an active delivery period is the opposite of what normally occurs. It signals that institutional buyers were actively acquiring new long positions and demanding immediate physical settlement, rather than waiting for forward months, rolling contracts backwards in time toward earlier delivery, not forwards. That is an inversion of normal market behavior. Traders roll contracts forward to defer delivery, not backward to accelerate it. The fact that this pattern appeared on CME Group's own published delivery reports, and that JP Morgan was at the center of it, is a data point that has received almost no sustained analysis in mainstream financial coverage. Samsung C&T, one of Samsung Group's trading arms, finalized a prepayment offtake agreement with Canada's Silver Storm Mining in October 2025, securing the exclusive right to purchase 100% of output from the La Paria silver mine in Mexico for 2 years following its restart. 6,000 meters of underground drilling at La Paria commenced in January 2026. Samsung did not go to COMEX to buy paper silver, it went directly to the mine. That is not how commodity procurement works in a market with abundant, reliable supply. Sprott Asset Management, the Canadian precious metals specialist, on January 20, 2026, updated its at-the-market equity program for the Sprott Physical Silver Trust, doubling its authorized capital raise from $1 billion to $2 billion, proceeds earmarked entirely for the purchase of physical silver bullion. At silver prices around that period, $2 billion represents approximately 18 million ounces of physical metal, equivalent to roughly 16% of the entire COMEX registered inventory at the time. An institution does not double its physical acquisition program in that fashion unless it believes the paper market is pricing silver materially below what physical scarcity justifies. The structural deficit underpinning all of this is not new, but its scale is now confirmed over multiple years of data. The Silver Institute, in its World Silver Survey 2025 published with research by Metals Focus, reported that the global silver market ran a deficit of approximately 95 million ounces in 2025, marking the 5th consecutive annual shortfall. Over the 5-year period from 2021 through 2025, the cumulative deficit reached approximately 820 million ounces, close to an entire year of global mine output. The Silver Institute's report noted mine production remained essentially flat at around 813 million ounces annually, with global mine supply unable to respond quickly to higher prices because silver is predominantly a byproduct of copper, zinc, and gold extraction. The decision to build a new silver mine is driven by those primary metals, not by the silver price alone. On the demand side, the Silver Institute's December 2025 report, produced in partnership with Oxford Economics, confirmed that industrial silver demand from photovoltaic solar, electric vehicles, and data center infrastructure, is forecast to grow at a compound rate through 2030. A research paper published in January 2026 in the journal Resources, Conservation and Recycling, authored by researchers at Ghent University and other European institutions, modeled that by 2030, global silver supply may meet only 62 to 70% of projected total demand. The historical parallel that is worth examining carefully, and examining honestly, is what happened to COMEX silver between 1979 and 1980. Nelson Bunker Hunt and William Herbert Hunt, Texas oil heirs, began accumulating physical silver in the early 1970s at below $2 per ounce, eventually controlling an estimated 100 million troy ounces by late 1979. Their accumulation, combined with broad investor buying driven by inflation fears following the collapse of the Bretton Woods gold standard, drove silver from $6 per ounce at the start of 1979 to a recorded high of $49.45 per ounce on the London Fix on January 18, 1980, with COMEX intraday futures reaching $50.35. On January 7, 1980, COMEX adopted Silver Rule 7, placing heavy restrictions on leveraged purchases and effectively imposing position limits. The Chicago Board of Trade subsequently restricted trading to liquidation only. With credit unavailable and rules changed mid-game, the price collapsed. Silver Thursday, March 27, 1980, saw prices fall from their elevated levels to $10.80 per ounce in a single session. The Hunts defaulted on margin calls totaling $1.7 billion. A consortium of banks, including Citibank and Bank of America, provided a $1.1 billion emergency loan. The parallel to today holds in some ways and fails in others, and it is important to be precise about both. It holds in the sense that physical demand is again outpacing what the paper market can service, that delivery rates are historically anomalous, and that institutional players are positioning aggressively. It fails in the central respect that the current deficit is structural and industrial, not speculative and concentrated. In 1980, one family and their Saudi business partners were estimated to control about a third of all non-governmental silver. Today, the demand pressure comes from solar manufacturers in China and Europe, electric vehicle battery systems, artificial intelligence data center hardware, and central banks in emerging markets adding silver alongside gold as a strategic reserve. This is not a corner being attempted by private actors. It is a systemic rebalancing between what the paper price says silver is worth and what industrial users and institutional buyers are willing to pay to secure real metal. The Bank of England's position in this story deserves attention. The LBMA, which administers the silver price benchmark through ICE Benchmark Administration, operates under Bank of England oversight. The silver lease rate, the cost of borrowing physical silver from a vault holder, spiked to multi-year highs in late 2025, as the Silver Institute noted in its November 2025 market update, describing an unprecedented liquidity squeeze in London during October that contributed to record-high lease rates. Roughly half of all silver-backed exchange-traded products globally are held in London LBMA vaults, the Silver Institute confirmed. When those products experience simultaneous redemption pressure at the same time industrial buyers are drawing down the same pool of metal, the LBMA's function as a clearing and pricing mechanism comes under the kind of stress it has rarely encountered. The Bank of England has said nothing publicly about silver specifically, but its responsibility for systemic stability in London financial markets places it directly in the frame of any sustained delivery crisis. Three things are worth watching closely in the next 48 to 72 hours. The CME Group publishes daily warehouse stock reports for COMEX silver, typically accessible by the following morning. The number to focus on is not total inventory, but registered inventory specifically. If registered stocks fall below 80 million ounces, they were at 86 million as of late February, that is a level at which the coverage ratio against current open interest enters historically unprecedented territory. The second thing to watch is the daily delivery notices report published by CME Group for the March 2026 contract, which is currently in its active delivery phase. At first notice day on February 27th, 10,526 contracts stood for delivery, 52.63 million ounces against 86 million registered. The daily pacing of those deliveries will indicate whether March sets another delivery record or whether the sharp price pullback seen this week, silver retreated from a high near $88.38 on March 10th to approximately $83.85 today, March 13th, has caused some of those longs to reconsider standing for metal. The third thing to watch is the next CFTC Commitments of Traders report, published on Fridays, which will show whether managed money positioning, which collapsed 77.72% year-on-year according to data from COMEX delivery analysis published in late February, continues to contract, or whether new speculative long positions are being established at current price levels. A resumption of speculative buying alongside continued industrial delivery demand would be the combination most likely to create acute supply stress. To summarize what the verified data shows, COMEX registered silver inventory has fallen 64% since April 2020, from 240 million ounces to approximately 86 million ounces, according to CME Group warehouse reports. The coverage ratio of deliverable metal against outstanding paper claims sits at 13.6%, in what analysts using CME data classify as stress territory. February 2026 recorded the highest delivery volume for that calendar month in modern COMEX history, at 25.18 million ounces, as documented in CME Group's monthly delivery reports. The global silver market has run a structural supply deficit for 5 consecutive years, with a cumulative shortfall of approximately 820 million ounces through 2025, as confirmed by the Silver Institute's World Silver Survey and metals-focused data. Shanghai physical inventories have declined 43% since November 2025, based on Shanghai Futures Exchange weekly reports, suggesting the physical demand pressure is not isolated to the Western exchange system. What the data suggests directionally, without offering any price prediction or timeline, is this. The mechanism by which paper prices have historically anchored physical silver market pricing is operating under greater stress than it has in decades. The delivery behavior recorded in CME Group reports over the past 3 months does not look like normal futures market activity. The institutional positioning moves, from JP Morgan's delivery notices to Sprott's doubled capital raise to Samsung's direct mine offtake, suggest that some of the largest and most well-resourced players in global commodities markets have concluded that securing physical metal through the exchange system is either insufficient or unreliable at current prices. What happens when that conclusion becomes more widely shared is a question the data cannot answer. What it can do is tell you to watch the vault reports, the delivery pacing, and the CFTC data very closely over the days ahead. Thank you for watching this video. The question worth thinking about for the comments section is this. If the structural deficit in silver is genuinely driven by industrial demand from solar, EVs, and AI infrastructure rather than speculation, what would a normalization of price actually require? More supply? Less demand? Or something the market has not yet priced in? This video is for educational purposes only and does not constitute financial advice. All figures cited from COMEX, the CME Group, the Silver Institute, the LBMA, the Shanghai Futures Exchange, and the Shanghai Gold Exchange are publicly available and linked in the description. Verify every figure independently before making any financial decision.